Your intelligence is destroying your wealth. We are taught that investing belongs to the experts, to the geniuses. But the data proves otherwise. A janitor who buys the boring stuff and waits will outperform a Harvard MBA who tries to time the market. Every single time. Right now, you are likely sitting on the sidelines. You know you should be investing, but you are paralyzed. You look at the headlines: AI bubbles, geopolitical tension, interest rates. You tell yourself, I will just wait for things to calm down. But here is the twist: things never calm down. Uncertainty is the price of admission for returns. If you wait for perfect clarity, you will wait until it is too late. The financial industry profits from your confusion. They want you to think it is complicated, so you pay them fees to manage it. Complexity is their business model. Simplicity is yours. In this video, we are going to ignore the hype. We are going to build a strategy that works whether the market goes up, down, or sideways. Most people think they need a lot of money to start investing. That is backwards. You need to start investing to have a lot of money. So, if you are ready to stop guessing and start building, pay attention. The strategy I am about to share is boring. It is slow, and it works. But first, here is the uncomfortable truth about why you haven't started yet. It isn't because you don't know enough, it is because you know too much. We live in an era where financial data is infinite. You can open your phone right now and read analysis on supply chains and price to earnings ratios. You are drowning in information and you have convinced yourself that this information is an advantage. But in the world of wealth, information does not equal insight. In fact, for the beginner, more information usually leads to worse decisions. It creates analysis paralysis. You feel like you need to understand the bond market before you buy a single stock. Let me save you some time. You will never fully understand it, and the good news is you don't have to. The most successful investors I know, people with 8 and 9-figure portfolios, spend almost zero time analyzing the news. They aren't glued to CNBC. They understand a fundamental truth that most beginners miss. The market pays you for discipline, not for IQ. The second barrier holding you back is the addiction to certainty. You are waiting for the perfect time. You look at the market hitting all-time highs and think, I can't buy now, it is too expensive. Or you look at the market crashing and think, I can't buy now, it is too dangerous. Do you see the trap? To the emotional brain, there is never a good time to invest. Certainty is expensive. By the time the dust settles and the outlook is clear, the opportunity for the biggest gains is already gone. You pay for clarity with lower returns. This is the complexity bias. We are hardwired to believe that complex problems require complex solutions. We think that to build $1 million portfolio, we need a complex algorithm, but the math doesn't care about complexity. A boring index fund bought consistently by a teacher will mathematically crush a hedge fund strategy that tries to be clever but gets eaten alive by fees. So, we need to make a deal right now. You have to be willing to look stupid to the experts. You have to be willing to be bored, because the problem isn't that you can't find the right stock. The problem is that you are trying to solve a psychological problem with a mathematical solution. The solution to this paralysis is a strategy that feels almost illegal in its simplicity. We are not going to try to find the needle in the haystack. We are just going to buy the haystack. This is index investing. This is the exact strategy Warren Buffett recommends for his own wife's inheritance. It is the strategy that mathematically beats 90% of professional money managers over a 15-year period. Think about that for a moment. Professionals who work 80 hours a week and have access to supercomputers lose to a strategy that simply buys everything and does nothing. How is that possible? It comes down to cost and probability. When you try to pick individual winners, you are playing a zero-sum game against the smartest algorithms in the world. To win, you have to be right twice. You have to buy at the perfect time, and you have to sell at the perfect time. Our strategy removes the need to be right. We are going to achieve this using just 3 simple components. Think of them as 3 buckets that hold your wealth. The first bucket is the total US stock market. This captures the growth of the giants like Apple and Amazon, but also thousands of mid-sized companies doing the real work of the economy. When you buy this, you are hiring every employee at every public company in America to work for you. They get up at 6 a.m., solve problems, and generate profits so that you can compound your wealth. The second bucket is international stocks. This ensures that if the US economy stumbles, you capture the growth happening in Europe, Asia, and emerging markets. You are betting on the world, not just one country. The third bucket is bonds. This is your safety brake. It doesn't grow as fast, but it stabilizes your portfolio so you don't panic and sell when the stock market inevitably drops. That is it. 3 funds. Now, I can hear your ego resisting this. You might be thinking, but I don't want average returns. I want to beat the market. This is the most dangerous linguistic trap in finance. In the stock market, the average return is not mediocre performance. It is superior performance. Because the market return is the average of all money invested, and active traders pay massive fees and taxes to shuffle that money around, the average index investor actually ends up in the top 10% of outcomes simply by keeping their costs low. You are not settling for average. You are ruthlessly optimizing for the highest probability of wealth. So we have the philosophy. Now we need the mechanics. You don't need a financial advisor to do this. You just need to know which buttons to press. The first barrier is purely logistical. Which brokerage do you use? Robinhood, Fidelity, Vanguard, Schwab? Let's dismantle this fear immediately. In the modern era, the major brokerages are commodities. They are utilities, like the power company. Whether you use Fidelity or Schwab, the electricity they deliver, the access to the stock market, is exactly the same. Do not spend 3 weeks researching which app has the prettiest interface. That is procrastination masquerading as productivity. Pick one of the major established custodians, Fidelity, Vanguard, or Schwab. Download the app, link your bank account, and move on. This step should take you 15 minutes, not 15 days. Now, before we buy the funds, we need to distinguish between the account and the investment. This is the single most common confusion point I see among smart professionals. Think of the account like a garage. You can build a garage, but that doesn't mean you have a car in it yet. Opening a Roth IRA is just building the garage. If you transfer money into it and do nothing else, that money sits there in cash, losing value to inflation every single day. You have an empty garage. To build wealth, you have to park a car in that garage. The car is the index fund. But which garage should you build first? This is where we apply the financial waterfall. It is a hierarchy of efficiency designed to keep more of your money away from the taxman. Your first step is your employer's 401k, but only up to the match. If your company offers to match 3% of your salary and you don't take it, you are literally declining a pay raise. That is a guaranteed 100% return on your money instantly. Once you have captured that free money, your next stop is a Roth IRA. The Roth IRA is the greatest gift the government has ever given the working class. You pay taxes on the money now, but it grows tax-free, forever. When you pull that money out in retirement, you pay 0 taxes. If your portfolio grows to $1 million, that is $1 million for you, not 700,000 for you, and 300 for the IRS. Once you max that out, you move to a standard individual brokerage account. This is where your liquidity lives. So you have opened the account, you have transferred the money, now you need to buy the assets. Recall our 3 buckets: total US, international, and bonds. You don't need to scour the earth for these. For the US stock market, look for a total market index fund, ticker symbols like VTI or FZROX. For international, look for VXS. For bonds, look for BND. The specific ticker symbol matters far less than the underlying strategy. Now comes the question that paralyzes everyone. How much of each do I buy? This is called asset allocation. And again, people treat this like rocket science when it is actually about emotional management. The standard advice is your age in bonds. If you are 30, have 30% bonds. I find this outdated. In a world where people live to 90, being too conservative too early is a risk. If you are under 40 and have a steady income, you want growth. A common, aggressive split would be 60% US stocks, 20% international, and 20% bonds. If you have a higher risk tolerance, meaning you won't panic if your account drops 30% temporarily, you might skip bonds entirely for now. Go 80% US and 20% international. There is no perfect allocation. There is only the allocation that allows you to sleep at night. If an aggressive portfolio makes you panic sell during a crash, it was a bad portfolio for you, even if the math was theoretically optimal. So, make a decision. Write it down. Do not overthink the percentages. What determines your fate is your savings rate and your time in the market. The allocation is just fine tuning. Now we arrive at the most critical step, the step that separates the wealthy from the well intentioned: automation. You cannot rely on your willpower to invest. Willpower is a depreciating asset. You have a lot of it on Monday morning and none of it by Friday night. If you rely on manually buying stocks every month, you will fail. You must remove the human element from the equation. Every major brokerage allows you to set up automatic investments. You tell the system, on the 5th of every month, pull $500 and buy these funds. Set it, and then walk away. This is called paying yourself first. Most people spend their money, pay their bills, and invest what is left over. Inevitably, nothing is left over. The wealthy invert this. The money leaves their account before they even see it. It creates a forced scarcity that disciplines your spending without you having to think about it. When you automate this, you are utilizing a powerful tool called dollar cost averaging. When the market is high, your $500 buys fewer shares. When the market crashes, your $500 buys more shares. You actually want the market to drop when you are in the accumulation phase. You want shares to go on sale. By automating, you ensure that you buy the dip without having to summon the courage to do it. While everyone else is panicking, your automated system is quietly buying more shares at a discount. You become a contrarian investor simply by doing nothing. Now, once you have set this machine in motion, a new question arises. You are putting money away, but how do you know if it is enough? Most people have a vague idea of $1 million, but that number is arbitrary. We need to calculate your specific freedom number. And to do that, we need the rule of 25. This is derived from economic research which proved that if you withdraw 4% of your portfolio annually, your money should last 30 years or more. So, the math is simple. Take your annual expenses, everything you spend in a year to live a comfortable life, and multiply it by 25. If you spend $40,000 a year, your freedom number is $1 million. If you spend $100,000 a year, your freedom number is 2.5 million. Do you see what just happened? The goalpost stopped moving. For the first time in your life, you are not chasing more. You are chasing a specific static target. This clarity is a superpower. When you know exactly where the finish line is, the race becomes bearable. This equation also reveals the most underappreciated lever in wealth building. Most people obsess over their income, but the math says your spending is actually twice as powerful as your income. When you cut your annual spending by $5,000, you don't just save $5,000. You lower your freedom number by $125,000. You are attacking the problem from both sides. So, do the math right now. Calculate your annual spend. Multiply by 25. Write that number on a post-it note and stick it to your monitor. That is not just a number, that is the price of your freedom. And once you have that number, the only variable left is time. This brings us full circle. We started this conversation by saying the biggest risk to your wealth is your own intelligence. Now you see why. Smart people can rationalize doing nothing. They can find a million logical reasons why the world is too unstable to invest right now. But investing is fundamentally an act of rebellion. By buying the entire market, you are opting out of the rat race. You are refusing to rely solely on your labor for survival. You are shifting from being a consumer of the economy to being an owner of the economy. That shift changes your physiology. When you are an owner, you stop cheering for crashes so you can feel vindicated and you start seeing them as opportunities. Now, I need to give you one final warning. The hardest part of this journey is not starting, it is staying. In 3 months, the excitement of this new strategy will fade. The market will inevitably drop. The news will scream recession. Your emotional brain will scream at you to intervene, to sell. Do not touch it. Real wealth belongs to the Stoics. It belongs to the people who can set a plan in 2026 and have the discipline to ignore it until 2036. Your behavior is the asset. The money is just the result. If this breakdown helped you find clarity in the noise, Subscribe. We don't chase trends here. We study principles. You have the map, you have the math, the rest is just patience. Close the app, go outside, and let compounding do the heavy lifting. I will see you in the next one.